Hey folks, I'm glad you came back for more cash flows and we're going to do the T account method. So I hope I don't make you dizzy. I'll try to change the screens as easily and slowly as possible. Okay, so what I have for you are the comparative balance sheets, year 2, year 1, and the change. So notice for cash that we started the year 1 or we ended year 1 with 22,000 and we ended year 2 with 73,000. So our change is a $51,000 increase. So that is going to be a debit to the cash accounts because we increased cash. Okay, so I have my comparative balance sheets. What you'll be given is these columns of information right here. And what you need to compute are these two columns here. And you simply compare year 1 to year 2, figure out the difference and whether the account increased or decreased. Then I did not give you an income statement. Instead, I told you what the net income was, and I told you what the depreciation expense is, and I told you how much the dividends were that you could have found on the earnings per share. But we're not doing earnings per share, so we're not going to go there. So I'm just going to give it to you. All right, and then we're going to make journal entries. So before we do the journal entries, I'm going to pretend that we've just seen the comparative balance sheets. So what we want to do is we want to create a T account for every account on the balance sheet. All right? And I think what I'm going to do is when we see that the cash has a $51,000 increase, when I go to my cash T account and I increase it for $51,000, I'm going to show that when we've looked at it, I'm going to turn it blue. Okay? So the next, let's see, how can I do this? The next, let's look at assets. Okay, they go in the order accounts receivable, inventory, land, equipment, and accumulated depreciation. I know, y'all got that right. I'm going to get my little worksheet out here. A little bit of a cheat sheet, not totally, but it has the order. And then when I go over and I have just my changes here, I can see it. So accounts receivable is the second current asset. Notice that we have a $9,000 increase for accounts receivable. So we're going to make that blue. I'll go ahead and make the cash blue. And because accounts receivable increased, that would also be a debit. Inventory is next. So I went, and that's a $9,000 decrease. Okay, so inventory is going to have a $9,000 decrease, which will be a credit. And I need to show that I took care of that one. I got to come over a little bit more. I wonder if you guys can see it if I just make the screen smaller. Let me try that for just a minute. Okay, next we have equipment, and it's no we don't, we have land next. And land is a $25,000 decrease. I'm going to go ahead and make it blue. We've got land is an asset, so if I decrease it, that's a credit, $25,000. Next is equipment, and it is a $50,000 increase. So equipment increases, it's an asset, so it debits for $50,000 because that's the increase. And then the last contra asset is accumulated depreciation. And notice that it increased. And the normal balance of accumulated depreciation is a credit. So if we increase accumulated depreciation, it has to be on the credit side. Okay, down in the liabilities and equity, the first one is accounts payable, and it decreased. So accounts payable has a normal credit balance. So to decrease, we are going to debit it. And I need to get that one blue. All right. After that, we have bonds payable, and they also decreased. Why do you think bonds payable would decrease? I bet we paid on them. What do you think? Okay, so we decreased bonds payable with a debit. And the next one, common stock increases. So common stock is an equity account. So the equity account, if it increases, has to be a credit. So 50,000 increase there. And then retained earnings has an increase of 65. And retained earnings it's an equity account also, so it has a normal credit balance. So we're going to credit 65,000. Now, I want you to pay attention. In our retained earnings, this is where we're going to have our closing entries, and we're going to have, you should see net income as a credit if you had income. It'd be a debit if it was a loss. And if you pay dividends, they're going to decrease your retained earnings, so they should be the debit. And then once you've made those journal entries, the net should explain that change in retained earnings. Okay, we have all of our balance sheet accounts there, so we're good to go. Notice what I did with my cash T account. I made a big T account for cash, and this is really my draft cash flow statement. So I'm going to set up a section for operating activities, a section for investing, a section for financing, and then I'm going to have my cash reconciliation at the very bottom of it, which is this section 4. And we did not have any non-cash investing and financing activities, so I don't have that section in this particular example. Okay, the other thing I did is when I debit cash, I actually put it on the debit side. But when I credited cash and decreased it, I'm going to put it on the debit side with parentheses. So don't let that confuse you, because what I want to show, because it's a draft statement, I want to show that you combine everything on this side to come up with the subtotal, and then you add the subtotals to get your increase in cash or decrease, whatever it happens to be for that problem. All right, I'll go through that again. All right, so the next thing we're going to do is we are going to make our journal entries to record our additional information. So information number 1, net income for year 2 is $135,000. So remember, on these journal entries, we are not recording these in our books. So to record net income, we're going to debit cash and credit retained earnings. So the cash of $135 right there is going to hit the operating section of, let's see if I can do this right there. It's going to hit our operating section of the cash flow statement as a debit because we debited cash. Retained earnings gets a credit of $135 because when we have income, whoops, I went too far, sorry guys. And I didn't get that blue a while ago. I was talking. Okay, net income gets a credit because income will increase retained earnings. And notice I have my reference for journal entry number 1 there. And that takes care of the first entry. All right. Information number 2, cash dividends of $70,000 were declared and paid. So journal entry number 2 is to record dividends. Dividends decrease retained earnings, so I'm going to debit retained earnings and credit cash. Okay, the reason we pay dividends is because we've issued stock. So stock is equity, and we finance our company with debt and equity. So when we pay dividends, that is a use of cash. That will be a credit to cash right here in the financing activity. There's my blue and blue. And I'm going to debit retained earnings to show that I paid the dividends right here, and it's referenced to journal entry number 2. So if I take 135 minus 70, that's going to give me my balance, So that one I have explained, and I am done with retained earnings, and I don't have to look at it again, and I'll just go ahead and make that heading blue to show that we're done with it. Alright, the next one, additional information, is depreciation expense was $24,000. So journal entry number 3, we're going to record the depreciation expense by debiting depreciation expense and crediting accumulated depreciation. But remember, that doesn't use cash, and what we want is we want the depreciation expense to be, it didn't use cash, so we're going to add it back to our accrual basis net income because it didn't use cash. So what I want to do here, I want to debit cash in the operating section. So we're going to add depreciation expense, so 24, and I'm going to credit the accumulated depreciation for 24 in the account, and I've got that one, and that is it. That explains the change in the account. Done with it. Blew it out. Alright, number 4. Bonds payable amounting to $50,000 were redeemed for cash of $50,000. That's just a fancy way of saying that we paid on our bonds. So when bonds are redeemed, it means we paid some of them off. So you decrease your bonds payable with a debit of $50,000, and I will do that over here. Bonds payable, debit $50,000, and you know that explains that balance, so we're done with that account. Oops, dang it, sorry. On the cash side, I'm going to credit cash because if I paid off the bonds, that used some cash. Bonds payable is a long-term debt, so that goes in the financing area. So when I paid bonds, that is a use or a credit of cash. So I'll put parentheses around it. All right, additional information number 5 is we issued common stock for $50,000 in cash. So our journal entry is a debit to cash of $50,000. Common stock is equity, so the cash goes in the financing section because it's equity, and the common stock credit, where we increased it, goes to our common stock T account, a credit of $50,000. That explains the change of $50,000, and we're done with that account. Okay, so let's kind of look up and see at our accounts kind of how we're doing here. We've got common stock and retained earnings taken care of. We have bonds payable done. We have accumulated depreciation. But you know what? We don't have land or equipment. So land is there first. It decreased. So why do you think land decreased? Well, if we had to have gotten rid of some land, right? So we probably sold it. Since it didn't tell us anything in the additional information, we'll just assume that we sold it for whatever the change is in the land account. So that was $25,000. So I'm going to debit cash for $25,000. And land is a long-term asset, so it goes in investing activities. And we're going to debit the cash for $25,000. Okay, and we're going to credit land because we got rid of it for $25,000, and I'm going to go over to the land account and credit it for $25,000, and that explains that change, and that account is taken care of. Okay, equipment increased. So what would cause equipment account to increase? You know, I bet we bought some. So if that's the case, then what we did is we debit equipment for the $50,000. And I'm going to come over here and take care of that. Whoops, go up a little more. Debit equipment for $50,000. That takes care of that account, so we blew it out. And then the cash on that equipment account, this blue really helps me find my place. I'm glad we're doing this. So we're going to credit cash when we purchase equipment. Equipment is a long-term asset, so it goes in the investing section. Purchase equipment, $50,000. All right, so now we're done with all of the long-term accounts, and all we have left are accounts receivable, inventory, and accounts payable. So we're simply going to take them one at a time. So accounts receivable looks like it increased by $9,000. So when accounts receivable increases, I have to debit accounts receivable for $9,000, and I'll do that up on the account. Debit accounts receivable for $9,000 explains that account, so we're done there. And we will, whatever the opposite is, so if we debited accounts receivable for $9, I have to credit cash for $9. Because it is a current asset account, it will be, I didn't mean to do the whole thing. Let's undo that. I'm just going to credit the $9,000, and that would be a use of cash. So an increase in accounts receivable is a use of cash or a decrease. So let me go over and show you something. Up here, current assets, when they increased, we used cash. So if you want to remember it by the journal entry, I think that's a really easy way to do it. So if a current asset increases, you debit the current asset and you credit cash, and you've used up cash, and that's how you know. All right, in inventory, what we're going to see is that the inventory account decreased. So I'm going to go over and make sure that we get that $9,000 recorded in our inventory account as a decrease, and we do. That explains the change in the inventory account, so we're done there. And when the inventory account decreases, what happens to cash? You're right, it increases. It's a current asset, so when the current asset decreases, I'm going to increase my cash because we sold some inventory. And then the last one, it looks like accounts payable has decreased by $13,000. That's the change. Go up to my T account. I went too far, of course. Debit accounts payable for the decrease. That takes care of that account. And I will increase cash for the $13,000. Accounts payable decreased, so cash, so if accounts payable decrease, that's a debit, and we credit cash, so we're going to decrease our cash. We paid off our accounts payable. All right, if you'll notice, I have something here, but it's only needed for the worksheet method, so I'm not going to go there right now, okay? We'll do that on the next video. So I'm going to keep it with the T account method now. So we look over our T accounts. Every account has been taken care of. So what I want to do now is I want to make sure I come back to this $51,000 because that's my check figure. So combine the debits and credits in cash in the operating activities, and it should come back to $146,000, which is cash provided by operating activities. The investing activities used cash of $25,000, and the financing activities used cash of $70,000. It's a good thing operations provided some. If you combine those three numbers, lo and behold, you come back to the $51,000 increase in cash, which was our check figure, and that's exactly what we wanted. So to do the cash reconciliation, you add the beginning balance of cash right there, and 51 plus 22 is going to come back to your ending balance of cash of 73. Okay, and then put the draft statement in good form, and you are good to go. Okay, under 20 minutes. We'll come back and we'll do the worksheet method. Okay. If you need to watch it 5 times, you watch it 5 times, whatever it takes. All right. Good luck. Bye-bye.